Much of the focus over the week is expected to be on retail and hospitality as the next phase of lockdown ends. But as many of us embrace our newfound freedoms with a pint in a local beer garden or a much-needed haircut, it's also illustrative to look back at how the economy has been weathering the storm. Economic activity dropped back in January as new restrictions were imposed, but February's GDP figures are expected to paint a more optimistic picture and should give more clarity on how far the first quarter drop in output will be. 2020 delivered the kind of records most of us would like to forget, with the worst annual GDP slump in 300 years. But revised figures show that slump was marginally less than initially thought, down 9.8% rather than 9.9%, and economists are optimistic that the UK will outperform its European counterparts this year in terms of growth. And that growth is expected to be rapid, with the Governor of the Bank of England optimistic the economy could rebound to pre-pandemic levels by the end of the year. Q1's expected to be 2021's outlier, but it has huge significance, demonstrating how adaptable the country's become and how it will cope with any future lockdowns if they're needed. Arguably, another set of figures being released by the Office for National Statistics has greater significance this week. Trade between the UK and EU fell significantly at the start of 2021. February's figures will help determine if that decline was a blip or the start of a long-term shift. January's numbers were startling in scale. Exports to the EU fell 40.7%. Goods coming in the other way were down almost 30%. Now, Brexit's almost certainly played a key part, and a recent survey carried out by the Federation of Small Businesses found that 1 in 5 exporters contacted had temporarily paused sales to the EU because of red tape. Teething troubles can only be blamed for so long, and February's figures will be weighed carefully. Of course, Brexit hasn't been the only issue affecting trade. COVID has disrupted the global status quo, and supply issues could play a major part in dampening post-pandemic recoveries. If you're one of many looking to give your garden a makeover, ready to welcome guests as restrictions ease, you may already have felt those global disruptions. Some garden furniture now comes with a 6-month lead time. Soaring demand for such non-food items is expected to give another boost to retail figures. Last month's BRC sales monitor showed positive growth of 9.5%, powered by the publication of the government's roadmap to reopening. Expect school uniform sales to be replaced by the aforementioned garden accoutrements in the March figures due out this week. And expect a couple of big retailers to dominate the headlines in what will be a busy week of corporate updates. Full or half-year results or trading updates to note may include the following, though, as always, please note they are subject to change. On Monday the 12th of April, consultancy firm Elixir and Belvoir. JD Sports, Revolution Bars and building material company Sigma Rock on the 13th. Builders merchants Travis Perkins, Naked Wines and sports betting company Entain on the 15th. Oilfield services company Petrofac and investment management firm Man Group on the 16th. But the company most likely to get people talking in the week ahead is Tesco. The grocer is scheduled to release its full-year results on Wednesday the 14th of April, and this will be investors' first real chance to see what impact the new Chief Executive Officer Ken Murphy is making. Tesco saw its share of the UK grocery market rise for the first time in more than 4 years in February, according to consultants Kantar World Panel, and the grocer's Christmas trading update recorded record sales. Indeed, the whole sector has benefited from changing shopping patterns during the pandemic, which is why Tesco's rather lacklustre share price performance over the past year might have disappointed. There are reasons for caution which will be on the mind of all supermarkets, not just Tesco. First, strong growth is expected to slip away as the country comes out of lockdown and consumers have more choice in where they can eat. Second, this is a highly competitive market, and new kids on the block, the Issa brothers, are seeking to disrupt things by pledging to spend £100 million on discounts and advertising at Asda. Add to that the fact the sector's already shifting, with relationships between Marks & Spencer and Ocado and Morrison's with Amazon developing nicely, whilst Aldi's click and collect and delivery services have now been rolled out to over 200 UK stores. Finally, the pandemic has seen the shift to online shopping rocket. And despite increased volumes, online still isn't as profitable as in-store. In its Christmas trading update, it recorded online sales in the 19 weeks, including Christmas, were up 80%. But that extra £1 billion worth of sales comes at a time that social distancing measures required the pick rate to be suppressed by 10 to 20%. Bigger baskets have helped, though there is a question of whether people will go back to shopping little and often when restrictions are further relaxed. However, Ken Murphy told Analyst he believes it is possible to get close to equivalence online and offline eventually. Overall, Tesco's management expects 2021 operating profits to be broadly in line with that of 2020, excluding the repayment of business rate relief. Its Q3 trading update in January recorded group sales up 6.1% year-on-year on a like-for-like basis, with the UK up 7.2%. Business at wholesale arm Booker was unsurprisingly muted as lockdown prevented restaurants from opening up over Christmas, with like-for-like sales down 2.5% for the whole 19-week period. Strong retail demand helped counter the slump in sales to the catering trade, which was down 30% in Q3, rising to 49% over the Christmas period. The cost of doing business during a pandemic hasn't been cheap, but assuring the safety of customers has increased brand loyalty, according to Ken Murphy. When it comes to the full-year results, analysts will look to three key sets of figures. The first is like-for-like sales. Elevated sales have been described by the business as the key to offsetting additional COVID-19 costs, which the last trading update estimated has risen by £85 million to £810 million. They'll also be looking to see if retail sales have managed to completely offset losses from the catering trade in its book of business. The second is the headline pre-tax profit number. For the full year, analysts' mid-range consensus forecast comes in at £891 million, down from £1.3 billion in the year to February 2020 on a stated basis. Profits are expected to be weighed down not only by the previously mentioned COVID costs, but also the repayment of business rate relief. Now, the third is the dividend. Tesco has slowly rebuilt its payment up from 2016 and 2017 when it offered nothing. And in the year to February 2021, the firm paid out 59.04 pence a share, which included a special dividend payment of 50.93 pence a share following the sale of its business in Thailand and Malaysia. That payout was followed by a share consolidation, which kept share prices from tumbling. Investors will be hoping to see payouts continue at similar levels next year, excluding, of course, the special dividend. Other things worth mentioning, the Polish regulator last month gave the green light to the sale of Tesco's business there, which will see about 300 stores convert to the Netto brand. The last trading update reported strong levels of availability through the Brexit transition period. And finally, it's worth keeping an eye on Tesco Bank, with the company continuing to expect to report a loss of between £175 million and £200 million for the 2020-21 financial year. Now, Russ will be back with you next week after enjoying a well-earned Easter break. Thanks for listening.